Hey guys, welcome back to the channel. So in this video we're going to talk about how to look at stop loss placement, what kind of things you need to look at before putting a stop loss. So stop loss is quite important because you will avoid getting hit by the market when things like this happen. So if we look at it from this point of view, see, there was a lot of people entering the market at this point, this point, this point. It's going sideways. But then what happened here is market started to trend up, and then all of a sudden it just hit down. This is basically is just getting the liquidity. Why? What is this liquidity? Is a lot of people who bought, let's say they buy here, they buy here, they buy here, all these people, where do you think they will place their stop loss? Do you think that they will put a very large stop loss? I doubt that they will risk so much. So what they'll do is they will just put right below, maybe 20 pips or 25 pips, or 30 pips, things like this. So what tends to happen is when a collective group of people do the same thing, there's a lot of orders or a lot of stop loss, or what we call as liquidity, because stop loss is equivalent to money. So this is basically market is coming to those areas to take the liquidity and then go back in the same direction. So you can call this as a spring or a manipulation or whatever you can call it, but I look at it as a point where if there is a lot of one-sided traders doing one thing, what is missing in this picture? The missing point is, if you're taking a trade here, you need to be aware of what the market can do. Something like this too. So at this point, market started to range here, and then it's bleed down like this. So here we can look at it from a point of view where market has already hit all the stop loss here. It has a higher potential to retrace up, to show that those people that market is going to go up some more and then push down to this point, because the downtrend is not over yet. This is just to basically trap those buyers, and then market hit down, show some kind of retracement at this point, and then start to continue lower. So there will be another trap being held in this point, so it's being printed out. So we may look at this in the next video. I may be wrong, but from what I'm looking at this point is, if the market, there's a lot of buyers, the market has already started to push up. But what's happening is it's slowly pushing up and down. So we can see movement like this, and then price starts to drop back to the support. Because when market is about to switch, it'll be something like this. Market drop, and then all of a sudden a great volume enters the market. But here you see market drops, and then slowly tricking people into thinking that it's going to go higher. A lot of people put their take profit here, market never reach and then drop. So this is one play we see in Euro USD. So let's just take it as a as a educational thing that we can learn from this. This is not financial advice. I'm not asking you to sell, but we learn from this kind of patterns, because it's a simple pattern where the pattern is market impulsively go down and then they slowly go up, trick a lot of people in thinking that there's some kind of support here, and immediately market drop. So what we want to see is there another trick like this happening here, and then is it gonna hunt the stop loss at the bottom? So when you're putting a stop loss, make sure the stop loss is not at a point where the market is too easily being anyone can see. Basically what I mean by that is, let's say market is going up, and then market started to retrace, and then market is going something like this, and then you buy here and just put your stop loss here. What can happen is a small shakeout can, even though your prediction may be right, market goes up further, but this small gap that you give is not enough for the market movement. The best area to put your stop loss is where was the low started, the previous low. Put it there. At least you give the market room for it to play around before it continues up or it hits your stop loss. Okay, same thing for downtrend. Let's say it's going down, and then this was the highest point, and then it started to drop, and then market is retracing like this, and then you decided to take an entry here, a sell position. Don't put your stop loss here, because market can still continue up. Put your stop loss above this level, and always give some kind of buffer, because we are not wizards. We don't know exactly where the market, it's all about probability. We are all just playing a probability game, where we might think when this happened and this happened, there is a high probability that it might continue lower. So we take a probability, put a buffer, let's say 30 pips or 40 pips buffer from here, and then put your stop loss. So at least you give the market room to it before it drops. And what you also need to know is, different chart has different buffer zones. So when you're looking at GBP, JPY, this is a very volatile pair. The market can go up and down quickly. So this one you have to give a bigger buffer. Markets like USD CAD or AUD USD, something which has not much aggressive movement, then you can put a normal amount of buffer, maybe 25 pips. You can put a baseline of 25. If it's aggressive, you can put 50. So you have to back test it yourself, see from out of 10 trades how does it perform. If from the 10 trades or 20 trades that you have taken with the same way of trading, 25 pips is not enough, then move to 50 pips. If 50 pips is not enough, move to 75 pips. You have to tweak one parameter at a time. You cannot tweak everything, and if you never backtest it properly, you may be losing out a lot. Okay, so first thing is, do not place stop loss at a very visible and what everyone can see area. Second is, give a buffer zone. And third is, do proper backtesting, at least 50 trades or 20 trades, depending on what you think you can manage. If you think I want a real good proper so that I can be confident, take more trades. When you span your trading from 1 until, let's say, 50 trading testing, you have 50 different analysis. Then if that gives you a proper confidence, then it's good. But if you think you want to only test 5 very short, what happens if the next 5 you take, it all goes against you, and then the next 5 you take all goes favor to you? So your psychology might be affected here. So give it a long testing period. Do the hard work first. Test it. Out of these 50 trades, how many is in profit, how many follows the criteria, all this. If it does, then you have something called an edge. So once you have this edge, this is where you can start to slowly risk your own money. When there is no edge, it's basically all gambling. You're just gambling. Market is going to go up, market is going to go down. But when you know this edge, saying that okay, from this point, out of the 50 trades I take, it goes down, let's say from here it goes down 80% of the time, then that is an edge where you have back tested a specific way of trading that you can take advantage of. Not to say like, oh, market is dropping, I will maybe buy first or sell first. What can you justify from that? So this is very important. So you always have to backtest and practice on that same type of way of thinking. When you take a trade, you need to be peaceful. You can't be being miserable or being stressed out. You might take something different. We might think trading is an easy thing, but it is easy when you keep it everything simple. A lot of people like to complicate things in trading, thinking like, I need to have this much of numbers of lines, or I need to use this many amounts of indicator. Not like that. Think of it as a game of probability and your edge. What is your edge? Some people has edge using, like, maybe, let's say I give you an example, double EMA. That means when this cross that, then I take a trade. If it doesn't cross, I don't take a trade. So when you yourself say that you have an edge, you need to make sure that it fits perfectly with your backtesting, and you need to input all your parameters, everything, and make sure that every time you take a trade, buy or sell, it has to follow your rules. If it doesn't follow your rules, that means you're not backtesting properly. You are just anyhow backtesting. Make sure it follows every certain rule. One rule can be like this. Okay, for this double EMA, if the price breaks below the EMA impulsively, any pullback, I will take a trade. What kind of pullback? That's where you insert maybe Fibonacci. I will take 3 trades at 23%, 38% and 50%. So once that happens, you wait at 3 different levels to take a trade. So maybe the first one triggered, okay, then you ride. So this is just a simple example, but you need to craft your own rules. What are you looking at it to make it as an edge that nobody else knows? So this is where the challenging part comes. Something like this. See, market drop impulsively, you take a Fibonacci, put it to the bottom and say, I will take 3 trades, 20%, 38%, 50%. So all the trades triggered and then market drop. Something like this. So you need to have your own set of rules. What happens, why, when and how you will take the trade, and also your money management. You can't be risking 70% of your account in one trade. You have to maybe put, if you have $10,000 or $1,000, you're maybe only risking 1 or 2% per trade, or 0.5% per trade, something like this. That way you are always in the game. You're not going to get out of your account. You're not going to burst your account after 10 trades. You need to always be in the game. So that way you have to structure your plan properly. Okay, so this will be a short video just explaining about stop loss, explaining about how you can use buffer, explaining about proper back testing method. So there I will make a separate individual videos on each of these topics, more in depth. So this will be just a overview of what you can expect. Thank you so much for watching. Please do subscribe, like and share if you find this video helpful.